Good evening. This is the SI session being recorded via screencast for those of you that missed the SI review session earlier today for the first exam, or the second exam, I should say. It'll be pretty abridged because unfortunately I have about 15 minutes of this program to record, so I'm going to make it as brief as possible, but I hope you guys to prepare for the exam itself. For this session, I want to focus more on the more difficult aspects of this exam, basically the calculations and journal entries. So without further ado, I'm going to bust right into it. So starting with Chapter 5, when you're looking at the review sheet that Professor DeWitt supplied on Blackboard, looking at the first calculation for income statement, I'm going to zoom in here real quick to give you a better view of what I wrote on the board for our previous session. When you do the income statement, what you see right here, when you have any sort of sales, obviously as a seller, you have what's called sales revenue. Then you have your two contra revenue accounts, which of course being contra revenue accounts, they have a normal debit balance, which you'll see in the transactions that I prepared for this session also. The two are sales discounts and sales returns and allowances. They don't actually lower the sales revenue amount that you'll use for that account. It just lowers the overall net sales revenue. Then taking your net sales revenue, you're going to subtract any cost of goods sold during that certain period, which gives you the gross profit for your company. Then finally, subtracting any operating expenses, you're going to get a net income, or sometimes you might have a net loss. For the exam, you might see a fill-in-the-blank problem that's similar to brief exercise 5.1, where you might be given numbers like sales revenue and gross profit. To get their cost of goods sold, you basically take your sales revenue minus gross profit to get your cost of goods sold. In a similar problem, if you have gross profit, they may give you your net income. To get your operating expenses, you simply take your net income, subtract gross profit, and that'll give you your operating expenses for that calculation. To prepare you guys better for the buyer side, for the purchase transactions, for the journal entries, you have to keep in mind that for your entries, you're going to have 4 inventory accounts. Those are purchases, which will be debited. If the seller sells the buyer product and it's for an FOB shipping point, the buyer is responsible for that, meaning that it's another debit to your inventory and credit the cash that whatever the cost might be for that shipping cost. Your sales and discounts will be an inventory account as well, because that lowers the overall cost of the inventory for the buyer. And then finally, sales returns and allowances is also an inventory, because if you return those goods back to the seller as the owner slash buyer, you no longer own those goods. So to give you a better idea, I prepared some transactions without numbers, but what I did is did it for both the buyer and the seller side. So starting with the buyer side, on credit, you were sold goods with the credit terms of 2/10, which is 2% to be paid within 10 days, or net 30 to be paid full in 30 days if you don't take advantage of the credit with an FOB shipping. So for the original purchase, you want to debit your inventory and then credit accounts payable, both obviously for the same amount. Then you also, for the same transaction, you want to pay for your FOB shipping. It goes as inventory because, as I wrote here, it goes towards the cost of your inventory overall, and then credit cash. You might see a transaction, maybe not so much for this exam, where the seller may have the buyer pay for the shipping with the accounts payable, but for this exam, you're going to want to do it credit cash, as we learned in class. If you have to return any defective goods, you're going to debit your accounts payable because that's the return a seller is giving you. Therefore, it will lower the account that you, or the amount that you owe the seller, and credit your inventory for that return amount because you no longer own those goods. You've given them back to the seller. To pay your seller for the goods, you debit the accounts payable, and I forgot to write here, for the full amount, because, or let me back that up. The original full amount, subtract the return amount, because you have already been debited that by or credited the accounts receivable from the seller end, therefore your accounts payable has been lowered. So here when you pay the seller for the goods, it's just for the full amount, original amount, minus return amount. Then when you go to pay, obviously you credit cash because you're paying the seller, which is the original cost minus the return amount that you had up here multiplied by the 2%. Don't take the credit terms from the original amount because that's not exactly what you owe the seller because they've given you return. You owe less than the original cost because of that return that you were given. And then finally, you credit the inventory for the credit discount. So those are the 4 inventory transactions that you will have for, or as a buyer. It'll be the original purchase, your FOB shipping, both debits. Then your credits are the inventory for the return, and lastly, the credit inventory for the credit discount. On the seller side, same terms as before, 2% over 10, or within 10 days, net 30. For your original sale, you want to debit the accounts receivable because it's on credit. You're building the account for that customer to be paid later. Credit your sales revenue because, as we learned in previous the previous exam, as a seller, that's how they basically identify the money they've earned, are through revenue. Then you want to, in the same transaction, debit cost of goods sold and credit inventory. The reason being is because these two accounts must go together on this exam if you were doing it from the seller's point of view, because you don't know cost of goods sold without your inventory. So whatever the inventory is worth, which on the exam will be less than the purchase. So let's say for example that the purchase was for $10,000. The cost of goods sold will obviously be lower, so that way the seller can make a profit. So the cost of goods sold may be like 7,500, 8,000, something like that. On the exam, you'll be given that. It'll say like your purchase was for, or your sales order was for like $10,000, with the cost of goods being like 7,500 or something like that. So remember, these two always go hand in hand: cost of goods sold and credit inventory. For the return, you are debiting sales returns and allowances, again because it's a contra revenue account. You're debiting it because sales revenue, as you see up here, is a normal credit balance. So you're going to debit your sales returns and allowances for whatever the amount was worth, and then credit the accounts receivable because for your customer, you're crediting their account because they returned the goods to you. Then you debit your inventory because they sent those goods back to you. As you saw up here, the buyer gave the inventory back, therefore crediting their inventory account. And because now if it's defective but maybe not broken, the seller can put that return back in their inventory to be sold later. Therefore, you debit your inventory, and again, because they go hand in hand, you credit your cost of goods sold because that's no longer a cost to you as a seller. You didn't physically sell it in the long run, therefore you credit it to lower your cost of goods sold. Finally, when you receive your payment, you're going to debit cash, and just like for the buyer side, it's the original accounts receivable minus that sales returns and allowances that you had up here for the return, multiplied by the 2% for the credit terms. And just like with sales returns and allowances, you're going to debit your sales discounts because those are it's a contra revenue account. And then lastly, credit account receivable, just like before, for the full amount minus the return amount. So that's it from the journal entries on Chapter 5. Sales discounts, they have a calculation. Just go by this for both the seller and the buyer. The way that you, again, calculate that is just the original cost for the buyer minus the return amount that they return back to the seller, multiplied by whatever the credit terms are. And then same goes for the seller, just the original account receivable that they opened for the customer, minus the sales returns and allowances, multiplied by the 2%. And then, to go towards Chapter 6, and then on your own, you can pause the video and do the transactions here. I would have walked you through it, but unfortunately, like I said, I only have 15 minutes with this free app for my Mac, so I can't really do all of it. But I can give you the check figures as well. So real quick, going through your inventories with the FIFO, first in, first out, take all your goods existing at the earliest point in inventory, which in this case will be your beginning inventory, sell those and whatever purchases that are required which in this case, if the ending inventory is 450 units left, you're going to sell, if the total checkpoint number of units are 1,150. Therefore, for the FIFO, you're going to sell, and for the other two methods, you're going to sell 700 total. So you're going to take the 100 from FIFO, 250 from the first purchase, which will give you 350 total, all 300 from the second purchase, which will give you 650. Therefore, you only need 50 units from the final purchase to give you the 700. That will give you cost of goods sold, which is $12,000 for cost of goods sold. To get your inventory, simply take your total cost for your beginning inventory plus all your purchases, which for a checkpoint figure is 23,250. Subtract the 12,000 in cost of goods sold to give ending inventory of 11,250. For your last and first out, you use all the goods bought at the later point, which, going back to this example, is the last purchase of the $25 per unit product. Work your way up towards the earliest point. So since you need 700, it's 500 of the original or the latest purchase, which is the $25, last and first out. Then you only need 200 more of the $20 per unit product, which will give you a cost of goods sold checkpoint of 16,500. Taking that from the total cost of 23,250, you have an ending inventory of 6,750. Lastly, with the average cost method, also known as a weighted average, it's a method to find a per unit cost where you add up all of your initial inventory and your purchased units and the dollar totals, which again the checkpoints are 23,250 for the total cost. Your total units are 1,150. You divide the total cost by your total units. So for the checkpoint figure, your average cost per unit for this method is $20.22. That is rounded up. For your cost of goods sold, because you only need 700, you multiply the number of units sold, which is 700, times the average cost of $20.22 to get a cost of goods sold of $14,154. Taking that from the total cost of $23,250 will leave you with an ending inventory of $9,096. Another checkpoint average, when you write these numbers down, you'll notice that the average cost of goods sold, and ending inventory fall within the average or the ending inventory and cost of goods sold of both the FIFO and the LIFO. So when you're preparing for the exam and doing the exam tomorrow, you need to pay attention to that, because those average costs, if both the cost of goods sold and ending inventory do not fall within the figures that are for FIFO and LIFO, then something was done properly. And then, real quick to go back to this, for your turnover ratio and days in inventory calculations, for the turnover ratio, you're going to be given cost of goods sold, beginning inventory, ending inventory, and possibly sales revenue. Avoid sales revenue. You don't need it. You simply take your cost of goods sold, and then you're going to divide that by the quotient of your beginning inventory. Sorry, that should be plus. Sorry, because it's average. Beginning inventory plus your ending inventory divided by 2. That'll give you a certain number for the ratio, which you do first, obviously, before you do your days in inventory, which is for the full year. 365 calendar days divided by a turnover ratio will give you your number of days in inventory for that certain asset. And then lastly, real quick, only about a minute and a half left. For your petty cash transactions, for your original petty cash introduction, or when you begin the account, it's a debit petty cash, credit your cash. For all of your transactions, you want to debit all of your expenses, total those up, and then credit your cash. If the cash left in the box or drawer doesn't equal your expenses, if it's short, debit your cash over short, and if it's over, credit that number. And if you want to add more money to be used for petty cash for a different period, like a month for example, add only the additional amount, not the total. So whatever you increase it by, again, you're going to debit petty cash, credit cash. And then lastly, sorry, I got to find the right picture. This is a brief example of your bank statement, where you're going to have the original or the cash per bank statement given. You want to add your debits in transit, less subtract your outstanding checks to get your adjusted dollars per bank statement. On this side, for the books, you have your books that the number you have given for cash for your books, add your notes collected, plus interest, minus your collection fee, subtract your NSF checks and your bank service charge to get your adjusted dollars per books.